After thousands of hours live trading, forward testing, and back testing, I've been able to find the most consistent strategy to make money every day in less than 30 minutes. Just last week, I had a $27,000 day. And in this video, I'm going to cover the full strategy and teach you exactly how you could do this on your own. And at the end of the video, I'm even going to show you a 1-month back test to prove that it really works. So step one is to pull up your charts. And what you want to do is head over to a 30-minute time frame. So right now I'm looking at a 30-minute time frame over the last 10 days, and that just means that each bar represents 30 minutes of time. Now, step two, what you're going to want to do if you're using the same broker I am, you'll go to studies. Whatever platform you use for charting and technical analysis, you should still have these same options. So you're going to want to apply two moving averages. They're going to be exponential moving averages, or EMAs. You're going to type in exponential and you're going to pull those up. Now, one exponential moving average is going to be the 65 and the other exponential moving average is going to be the 33. And then you're going to want to pull up a moving average envelope. Okay, you're going to type in envelope and you'll find moving average envelope, and your displace is going to remain 0. Your length is going to be 8 and your PCT above and below are going to be 1.17. That is the most important setting, and then make sure it is set to exponential. Price is going to be high plus low plus close divided by 3 for both of them, and same goes for EMAs. They're going to both be high plus low plus close divided by 3. Now, I've got AFRM pulled up here as the example. So what we're going to do is look at our two moving averages here in the center, okay? Our yellow and our blue. Now, when these moving averages come together and when they cross, that is going to be our entry signal. So when our yellow crosses below our blue, that is going to signal a short position. So again, when our yellow moving average crosses below our blue moving average, that means we are going to buy puts, right? So I trade option contracts. I'm able to bet on a stock going up or down by buying a put or a call. Now, on the other hand, if that yellow now crosses back above and crosses over blue, that would be our signal to buy calls or go long. So essentially across below blue, yellow crossing below blue is a bearish signal. And you could see that very clearly here, how yesterday, if you waited for the cross where yellow crossed below blue and you then took a short position, you can see how the rest of the day AFRM was selling off, okay, and trending to the downside. And if we find an example here over the last 10 days where yellow crossed above blue, and this did happen after market. Now, during pre-market and aftermarket, obviously, we're not able to trade options, but we saw that cross there. And then throughout the rest of the following day, AFRM was trading to the upside, was obviously green. So again, across below, we're going to short. Across above, we're going to go long. And now you're probably like, well, how do I actually know when to get out of this trade for a win or a loss? And we'll get there. But I just want to quickly mention, because I do have seats open inside of my mentorship. If you guys are interested in having access to sit over my shoulder, follow along, and watch me trade live every single morning, you'll be able to enter and exit, kind of copying those trades that I'm taking while learning the system yourself. So I'll put a link in the description below if you are interested, and I hope to see you over there. So everyone loves Tesla. Let's pull up Tesla and look at a couple more examples. Our moving averages, yellow here, we saw the cross, yellow cross below. Well, what does that tell us? That tells us get short upon the cross. Look at that. Today, Tesla is down 4%. So if we took shorts right off the open, we would be very green on that position. Now, when there's nothing going on, we don't want to trade this strategy during that time. We only want to trade this strategy when we get a cross, which is going to be about 15% of the time. Here we go again. They came together during aftermarket, during pre-market. They consolidated. We got the cross. Yellow took over, came on top, and then we saw a very bullish day. So again, you can trade both long and both short, just depending on if we get the cross above or below. All of these days where we didn't get a cross, we wouldn't be trading this strategy. Okay, so I say you can trade it every day, but you will have to look for different stocks to trade it on. And it's only going to be on a 30-minute time frame. It's going to be about 15% of the time when you're looking back on that 30-minute time frame where you will be able to trade this strategy. So keep that in mind. Here we go. Another example. Yellow, crossed above, enter calls, boom, straight up. So now we want to talk about how we're actually going to manage this trade, because it's great. We need to obviously know when to get in, but the more important thing is actually when we get out. So how are we going to manage that trade? And so we've got these two white lines you can see here. Now those two white lines, those are our moving average envelopes, okay? And we set that up obviously. And well, what these are going to do, these are going to act as take profit or stop loss levels. Again, you're going to see that there's an extremely high win rate behind this trading system. But of course, sometimes you will be wrong. And so when you're wrong, we'll use it as a stop. And when you're right, we'll use it as a take profit. So here's an example today on Tesla. Obviously, we had the cross coming into the open. You would have gotten short, which meant you would have bought puts here. And then you would have played the move down. And this is your take profit. As soon as we get close, we don't necessarily have to exactly touch because sometimes it'll get really close to touching, but that literally could just be the difference of making that moving average band a little bit wider. So you could do that as well if you want, but that would have been our take profit. Okay. And at the same time, we've got our stop loss. So we've got our stop loss trailing as we entered shorts. We've got our take profit, which is going to be moving. So with trading, we want to cut our losers fast and we want to let our winners run. And the great thing with this system is that by the nature of how it works, when you enter shorts, your stop loss is constantly going to be following you down. Okay. So as that moving average gets lower, you're going to be taking a smaller and smaller and smaller loss. If all of a sudden price turned around and moved back up, you'd be out here. Now, on the other hand, we're able to let these winners run significantly because that second moving average is going to trail down. And we're going to want to take profit as soon as we get really close or as soon as we touch it. Okay, so let's look at another example. Let's go back here off of the open entry. Let's say we buy our calls and we hold our calls up to here. That's our take profit. Okay, this would have been our stop loss. Here's our take profit. Another example, entry upon the open, we got our crossed above, we buy our calls, we trade the move up to our white take profit. Here's another example on ticker symbol B. Just today, we got our cross and we hit take profit on shorts. So sometimes it'll be a little bit lagged. Keep that in mind. The move might happen slightly before or begin happening slightly before they actually cross. What we're trying to identify is when they start to come together, when they start to converge, right? When they touch, and then when they cross. And we want to see and wait for confirmation of that cross to see if we're moving to the upside or to the downside. So then we can take our directional bet, either puts or either calls. Okay. And so sometimes it won't get there all the way. And if it doesn't get there, I'll just close that trade out at the end of the day, or I'll wait for it to get there if it's a swing. So keep that in mind as well. Here's a great example. Just today on NVIDIA, we could have been watching NVIDIA and had it on our pre-market watch list, heading into actually aftermarket. You can see here our aftermarket session, our pre-market session, and how the moving averages came together and they started trading flat. And then right off the open here, look at that. We crossed above. We had yellow overtake blue, cross to the upside. This would have been your entry. You would have bought your calls. You would have had your stop loss trailing down here, and you would have had your take profit trailing up here. Now look at that. High of day, 188. That would have been your take profit. So you would have traded the move from the open to high of day. It would have timed perfectly and lined up with that high of day. Very clean trade there. Here's another one. Cross, entry on calls, traded up, got really close, didn't quite get there, but you would have been green throughout the entirety of this trade, even if you were still holding at the end of the day and closed. So again, we're not going to quite get there on every move, but we try to get there. We'll try to get there, but again, it just kind of depends on the size of the move. Sometimes that will happen aftermarket. If you shorted here, you could see here how we touched aftermarket. So this could have been also a swing. Keep that in mind. I like defining these as either being a day trade or a swing trade before I get in. I think that's the cleanest way of doing it. And of course, with swing trading, we have no control as to what's happening aftermarket or pre-market. So we do want to be careful there, and we want to manage our risk as always. So let's run through what we've talked about. Well, first, we're going to find a stock. We're going to pull it up. We're going to try to identify a stock that has just crossed or is just about to cross. Now, if it crosses to the downside, obviously that would mean our yellow moving average or our golden moving average would cross over and then end up trading down below our blue. And that would be a short trade. We would buy puts. Whereas on the other hand, if we cross above, let's find an example. Here's a great example on Meta off of the open here, and we could have watched this leading up to pre-market. They came together, they converged, we had yellow cross above, boom, and this would have been our signal to get in calls. Another example here, entry on those, let's say here we cross, we got in calls, this would have been our take profit. So you'll find the cross, whether it crosses above or below, you'll enter a short or a long, and then whether you're short or long, again, either white line to the upside or white line to the downside, these are just our other two moving average envelopes, will act as a stop loss or take profit. So it's extremely simple. One thing I like to do when I enter, let's run through a theoretical example and I'll show you how I like to do this, is let's say IBM. Obviously, we watched this thing off the open, and I really like trading this strategy off the open because we can identify when our MAs come together. Crossed above, okay, so we would be buying calls. Now what I'm going to do is I'm going to edit my study. I'm going to change my upper band to green, okay, and then my lower band, I'm going to change to red. And then you can really visually see your stop loss and take profit. So we would have bought here, held our calls up to here, and we would have taken profit here. So you could see how that would have been a very nice TP. And I think you've seen almost in every single example we looked at, if you waited for the cross, if you got long or short upon the cross, and if you managed that trade based off of stop loss and TP using our envelope system, 9 out of 10 of these trades have hit our take profit. Okay, so yes, we've got the stop loss down here if we're actually wrong, but very, very rarely will we hit stops. This is a very, very high win rate strategy. And here is the back test, a month of trades. That was actually over 85 trades. You can see here our running P&L. Very, very clean P&L. You can see how our drawdowns are very minimum, and that is due to the very high win rate. And you can see that even more here when we look at our net daily P&L distribution, how we only had a couple red days, and they were pretty small relative to our bigger green days. So this strategy has been an A+ strategy for me to trade and will be in 2026. Now, if you want to trade live with me every single morning and watch this system put in practice, I'll put a link in the description below. Subscribe for more, and I'll see you in the next one.